Today we're going to cover the last module in Chapter 1, or Module 5, covering Learning Objective 5. We're going to be looking at the preparation of the financial statements, and for now, as I mentioned temporarily, we'll be preparing these statements directly from the accounting equation. The four basic financial statements that are primarily used by all companies, and these are the statements that represent the primary means of communicating financial information to external stakeholders. External stakeholders include stockholders, potential investors, the government, creditors, labor unions, insurance companies, the wide spectrum of user groups that we discussed earlier in this chapter. Now, the preparation of the statements typically follows a strict order. First, we prepare the income statement. Secondly, we prepare something known as the statement of retained earnings. And typically, corporations prepare a much larger statement or a much more detailed statement called the statement of stockholders' equity. So this is or statement of retained earnings or a statement of stockholders' equity. Statement of stockholders' equity includes significantly greater amount of information than the statement of retained earnings, but for this course we will focus on the statement of retained earnings. Third, we prepare the balance sheet, and fourth, we prepare the statement of cash flows. Now, the reason why this order is important is because the information feeds from one statement to the other. So the order is critical. Information on the income statement is needed to prepare the statement of retained earnings. Retained earnings is needed on the balance sheet, and then all of these statements will feed into the statement of cash flows. Another important point is that you must remember that the four basic financial statements are not the only way in which we communicate information to shareholders. In fact, in the annual report, we mentioned the SEC requires a 10K, an annual report, and of course there's the typical annual report to shareholders. They will also include footnotes, or what we might call footnote disclosures. That provide some qualitative information, also some numbers, some quantitative information as well. The first statement is the income statement. So once again, the order of preparation, let's start with the income statement. The income statement is a flow statement. It reports the changes in owner's wealth over a period of time. The income statement reports profit or loss, success or failure of the company's operations. So that success or failure, of course, will be net income or net loss. And it's over a period of time. Typically, that time period is 1 year. It could also be 1 quarter. If you have quarterly financial statements. Internally, next semester, when you deal with managerial accounting, it could in fact be 1 month or 1 week. Whatever the period of time, the income statement provides us, it's a flow statement again. It's the changes in wealth due to operations. Specifically, the income statement, or the statement of earnings or profit and loss, is a listing of revenues and gains, expenses and losses as we defined earlier in this chapter, and of course the resulting net income or net loss over a period of time. And again, it's the change in your wealth, the flow of wealth for one accounting period. And as we said, that could be a year or 1 quarter. The income statement includes what we call temporary accounts. Now, this is an extremely important term. Income statement accounts only last 1 accounting period. So I'm interested in sales for the first quarter, or I'm interested in sales for the year. Sales in 2014 will not affect my revenues in 2015. So temporary accounts only last one accounting period, and let's just say, for our purposes, for 1 year only. And because they only reflect 1 year, they're considered completed accounting cycles. A completed cycle means that I start on January 1st. Let's say my fiscal year is a calendar year. Start on January 1st. Have sales. Those sales end on December 31st. I want to know the total. How much did I earn in that year? What are my total revenues? What are my total expenses? And you can see that the model of the income statement is quite simple. It's revenues and gains. As we said, these are asset inflows or a reduction of obligations minus expenses or losses, and these are asset outflows or a reduction of assets or an increase in obligations. The income statement for Smart Touch, and this number may sound familiar, and I'm going to try to flip around in a minute and get that information for you. But I think if you recall, when we worked on the accounting equation in the last couple of modules, we said that revenues, which included both cash and credit sales, were 8.5 or 8,500. We had rent expense of 2,000, and we had 1,200 of salary expenses, and our net income was 5,300. Now, if we go back to that accounting equation, you'll notice that on the revenue side, we're using this total column to prepare the income statement. So the point I made when I introduced the first slide is that we are going to be using the accounting equation as the basis for preparing financial statements. The way you have to look at this is that the accounting equation are your books. These are your books and records. This is like a computer file or a computer system like QuickBooks or other types of systems that we use to accumulate accounting data. Right now, this is all we have. So we go to service revenue. It's 8.5, and notice we have both, as we said, you've got your cash sales of 5,500, and you had your credit sales of 3,000. Expenses, rent is 2,000, and your salary expense is 1,002. So the income statement is prepared directly from the accounting equation. Now remember, there's a couple of things to notice here as well. First, when you prepare an income statement, you have to look at the heading. Name of the company, followed by the title of the statement. And notice it says for the month ended. It's a single period. It is a flow, the change in wealth over that 1 month period of time. These are temporary accounts. They are not going to carry over period after period. They're considered to be temporary and completed accounting cycles. Now, the question is generally asked, how do you list the expenses? How do you know what expenses to list first? Well, you would generally list, if there is no reason to list one above the other, you would list them in order of magnitude, in size order. So the largest expense would be listed first. The largest expense would be listed first. However, in some cases, there are expenses that are critical to the company's operation. So a retail company, for example, JCPenney or Walmart, advertising is going to be a significant expense, and they may want to show you that expense first. The more they spend on advertising, the more successful the company will be. Pharmaceutical companies like Johnson & Johnson or technology companies like Apple would want you to see their research and development expense first. How much are they spending on research and development? Even if it's not their largest expense, it's their most important expense because it's critical to the success of their business. Now, there are exceptions, as I said, to the size order, and those exceptions are going to be based on the importance of the expenditure. So to summarize, income statement accounts are generally listed in the order of magnitude. The largest expenses would come first, but as I said, importance sometimes plays a key role of how these are, or how these expenses are placed on the income statement. So again, Johnson & Johnson and Apple would probably have a significant research cost, and it's critical to their success. The second statement is the statement of retained earnings. So we're now going to go to the second step. And now you're going to see why we need to prepare the income statement first. The statement of retained earnings shows the change in retained earnings during the period. We know that the change in retained earnings during the period is going to be net income or loss minus dividends. And of course, the information is, as I mentioned in the introduction, typically provided in a much more significant statement called the statement of changes in stockholders' equity. So the key is, again, to prepare income first. The net income or net loss is needed to prepare the statement of retained earnings. In this case, the statement of retained earnings is quite simple. And then once again, we do begin with our heading. So the first thing, name of the company, the statement, and notice that it's for the month ended, just like the income statement. So it's another flow statement. Just as the income statement is a flow. It's the change in retained earnings over a period of time. Notice again that the company begins with no retained earnings, and that's because in our example, Smart Touch just began operations in this particular year or in this month, and net income for the month comes from the income statement. So that's where the flow becomes critical. So from the income statement, the income number of $5,300 is now going to be used to prepare the statement of retained earnings. So again, the sequence or the order of preparation is absolutely critical. Both the income statement and the statement of retained earnings are flow statements. This is known as articulation, the fact that the income statement provides the data needed for the retained earnings statement, and the other part of articulation is the fact that the retained earnings is needed now in the balance sheet. So this is going to go to the balance sheet, which is our next statement. Okay. So it's going to go to the balance sheet. Now notice that the statement of retained earnings is net income minus dividends. So let me try to flip back to our accounting equation. So once again, if we look at retained earnings, it's going to be the sum of the original balance. We started with 0, and dividends, we started with no revenues and expenses. There were no retained earnings to start. There was no capital. So we had a 0 balance. During the year, we have net income of $5,300 from the income statement minus the dividends. So the accounting equation, again, becomes the source of preparation for the financial statements. And again, the articulation, the idea that the statements articulate, we'll say this again in several cases, that we've got the information from the income statement going to the statement of retained earnings, and then the ending retained earnings balance will go on the balance sheet. And the term, again, is called articulation, A-R-T-I-C-U-L-A-T-I-O-N, articulation. And articulation means that the statements will tie together. So, again, moving income into the statement of retained earnings, and then the ending retained earnings going to the balance sheet again is called financial statement or articulation. Therefore, we'll now be able to prepare the balance sheet. So once again, we've got income statement first, net income or net loss, feeds into that statement of retained earnings that we prepare second. Now that we've got retained earnings, which is net income or net loss, minus any dividends, that amount, that total amount, or the ending balance is now going to be moved to the balance sheet. And what are the balance sheet? Balance sheet reports assets, economic resources, and claims to those resources. Notice the difference. It's not over a period of time. It's at a period of time. So the balance sheet is not a flow statement. It's a position. Or the stock of wealth. So by definition, it's a static statement, a stock or a position statement. So specifically, balance sheet is a listing, or sometimes called, by the way, the statement of financial position. It's a listing of the assets, liabilities, and capital or equity of the entity at a point in time. At a point in time, not over a period of time. Notice the difference. Stock of wealth is different than the change in owner's wealth. And then within each category, we have sub-accounts. So if you look at assets, we know that the sub-accounts could be cash, inventory, prepaid expenses, accounts receivable, as we've already seen on the accounting equation. Now, the balance sheet, unlike the income statement accounts, are cumulative and they are permanent. So by cumulative, it means that their balances will accumulate and carry over from one period to the next. And because they carry over from one period, the cycles related to these accounts are not complete. So they are incomplete accounting cycles. So it means they have implications for the future. For instance, when you carry over your accounts payable, that is a permanent balance sheet account. It means that next period you're going to pay them. It's got implications. You bought land. The land is going to be used for production. Maybe you're going to build a building. So it's got future implications. And therefore, they carry over period after period. When we look at the balance sheet, we're going to find that the assets, you're asking about listing. Remember the income statement, we typically list revenues and expenses in order of magnitude unless there is some importance attached to a particular type of revenue or expense. Assets are now listed in what is known as the order in the United States. Not necessarily true worldwide, but under US GAAP, we list them in the order of liquidity. Liquidity, by definition, is the ability to convert an asset into cash with minimal risk of loss. And of course, cash would be the most liquid asset, and it's listed first. And we'll go back to this when we see our balance sheet. Liabilities are listed in the order of maturity. So the most current go first, and then long term. So if you had an accounts payable, that would be listed before an auto loan or a mortgage payable. And then in the contributed capital section, we list the common stock or the contributed capital before the retained earnings. So again, we're looking at the notion of the way in which we prepare the balance sheet. Now let's take a look at the balance sheet and notice that, of course, the balance sheet balances, but what I want you to be sure of is to understand, before we even get to the details of this statement, where did the numbers come from? Okay, the numbers will be taken from the bottom line of the accounting equation. So once again, reinforcing the fact that for now we must use the bottom line, the end result of the accounting equation in order to prepare the balance sheet. So cash is going to be $9,000. Accounts receivable, $1,000. Office supplies are going to be $500, and land is $20. Also on the balance sheet, we have accounts payable of $200. We've got capital stock of $30, and then of course we know the ending retained earnings balance is $300. It's the $5,300 of net income minus the $5,000 of dividends. So that information is the source data that we're going to use to prepare the balance sheet. Now let's get into the details of the balance sheet. Once again, the first thing we need to look at is the heading, name of the company, title of the statement, and notice that the balance sheet is at November 30th. It is at a point, a specific point in time. It is not for the month or over a period of time. So this is not a flow statement. This is a static or a stock statement. Stock of wealth. These are permanent accounts. Every account here is permanent. And these cycles are incomplete. Incomplete accounting cycles. A couple of things to notice. When we look at the retained earnings, remember this came from the statement of retained earnings. Notice also that the assets are listed in the order of liquidity. It's actually the order of decreasing liquidity. The most liquid is first, and the least liquid is land. Why? Liquidity is the ability to convert into cash with minimal risk of loss. You have cash already liquid. Accounts receivable. People will buy accounts receivable. They'll discount them, but they'll buy them. Office supplies, you could sell them quickly. Land, it takes time. There's a lot of legal issues that have to be resolved. So, before you could sell land, title has to pass, and it takes much longer to sell land than it would be to sell receivables and office supplies. Accounts payable would be, or liabilities, are listed in the order of maturity. Can't get this clean. There we go. Order of maturity. So the order of maturity means that the most current come first and then long term. Then you go to long term. Okay, current and then long term. Now, notice that the balance sheet follows the accounting equation. Assets, economic resources, followed by the claims against those resources. Assets equal liabilities plus equity. And our final statement is the statement of cash flows. So once again, what's the order of preparation? Income statement, statement of retained earnings, balance sheet, and then the cash flow statement. Cash flow statement answers the question of, or questions regarding where cash is generated and how cash is spent. Theoretically, what we're doing is we're converting the accrual basis into a cash basis. It is another flow statement, and it is over a period of time. So the company will prepare the statement of cash flows for a specific period of time, and again, it explains where the company receives its cash and how cash is going to be dispersed or how it's spent. When you prepare the statement of cash flows, and we'll do a little bit of it now, a lot more at the end of the semester, but a few things you should know at this point. The primary sections of the cash flow statement are based on the activities that generate and use cash. These activities are also called cycles: the operating, investing, and financing. When you look at an operating cycle, these are cash flows from revenues and expenses. It's really the cash generated from your normal operations from the income statement. So we've already looked at, if you remember, in Smart Touch, we already said, well, they've got $8,500 in sales. We know that $5,500 of that was a cash sale, and we also know that $3,000 of that amount was a credit sale. They collected $2,000 of that amount. So if you have cash sales of $55,000, just to remind you, they had cash sales. They also had credit sales. Of $3,000. So from the accrual basis, they had total revenue of $8,500. However, they only collected $2,000 of this receivable. So that means that cash collected is $5,500 cash sale plus the $2,000 accounts receivable collected. So their cash flow from revenue is $75,000. Accrual basis $85,000, cash basis $75,000. And we'll explain this, as we said, in more detail, not only now, but at the very end of the semester. Another activity are investing activities. Typically, it's cash generated or used by the following activities. When you sell land, or you sell a building, or you sell equipment, it's considered cash from investing activities. If you sell securities of other companies that you hold as investments, just like we can hold stock and bonds of other companies, the corporation could hold shares of stock of another company. When you buy land, when you buy stock of another company, when you buy a building or equipment, it uses cash from investing activities. And finally, the last activity is known as a financing activity. Financing is going to explain where you raised capital. You could borrow long-term notes. You could issue stock. We mentioned that Google issued stock. Facebook had an initial public offering. Twitter had an initial public offering to raise equity capital. Also, dividend payments are included in financing activities. So when you look at a cash flow statement, you need to be sure that you understand that the cash flow statement provides information that explains where the company received its cash and how the cash was dispersed. But it also helps us reconcile the changes in cash, the beginning and ending cash. So let me go to the whiteboard and give you the cash flow format. Statement of cash flows. And again, it is another flow statement. And it's going to be for the year ended. Let's say it's 12/31/2015. And of course here you have the company name. Now, you're going to start with operating activities. You'll have investing activities. And financing activities. And that is going to be in that order. The sum of financing cash flows, investing cash flows, and operating cash flows, some could be positive, some could be negative, would be the net change in cash net change in cash for the period. If you add the beginning cash balance, you will get the ending cash balance. And that's what I mentioned before, that this is the reconciliation. So not only do you look for sources and uses of cash from these activities, but we also need to reconcile the change or explain the change in cash. And one more point, we talked about articulation. This is the ending and the beginning cash balance. Where would you find that? Well, we're going to find that on the balance sheet. So this ties to the balance sheet. That ties to the balance sheet. And in the Smart Touch example, we know they started their business with 0 in cash and they ended with $9,000. Okay, so the cash flow statement, again, in summary, provides you with the sources and uses of cash from each operation, as well as providing you with the information that helps you explain the change in cash for the period. Now, going back, as I said, the sources of that information, again, to prepare the cash flow statement will be the balance sheet or accounting equation. Now, notice again that cash starts with 0 and it ends with 9,000. So the good thing, I mean, honestly, one of the things that I note when students look at cash flow statements, one of the things that is both a great help but also a disadvantage is that you know the answer. The answer is that cash went from 0 before they started their business to 9,000. So you know that no matter what you do on this statement, you have to come up with the change in cash at 9,000. The problem is when you don't get that answer because you're trying to generally force that amount. Now, we've already discussed the fact that cash from customers was $7,500. Let's see some other items, some other cash flows. Well, we know that rent is totally in cash. So there's a $2,000 outflow for cash. Salaries, we know, were $1,200, so that's a full cash expense. We also know the rent that we paid was $500. We paid $3, so therefore the cash paid for rent is going to be office supplies, excuse me, the office supplies. So the amount paid for office supplies is going to be $300. So again, rent expense is $2, all in cash. Salary expense is $1.2, that was all in cash. But the accounts payable related to the office supplies, you've got office supplies of $500, but you paid for $3. Now, you may not have used any of these, and in fact, you did not use any. Typically, from an accrual basis, we would say you don't have an expense. You didn't use anything. You have office supplies worth $500. That's what you owed, or now you owe $200, but you haven't used any. You don't have an expense, but from a cash basis, you spent $3,000. Then, of course, you spend $20,000, we know, to buy the land. And we also raised capital of $30,000 to sell common stock, and we also paid $5,000 in dividends. So we need now to package this into a statement of cash flows. All of those reasons that we just discussed, how cash was generated and how cash was used, must be articulated to or at least communicated to the financial statement user. The financial statement user must know that from operations, they had $7,500 in cash collections, that they spent $2,000 for rent, $1,002 for salaries, and $300 for supplies. They must also know their investments consisted of land. That's the only investing activity they made for the business. And their financing activities, they raised all their capital from equity and they paid dividends. So now, let's take a look at the statement of cash flows. And it's exactly as we said. We'll get to the numbers in a second. But once again, name of the company, statement, and for the month ended. So once again, it's a flow. It's a flow statement. Remember, mentioned this several times already, cash collected from customers with a total sales of 85, 5,500, and 3,000. This is a cash sale or a cash revenue. This is a credit sale. On the accrual basis, we have 85, but as I said, you only collected 2, so therefore, cash collected from customers is the sum of the 5,500 and the 2,000. Cash sales plus the receivables collected. Rent, pure cash expense. The same with salaries. Office supplies, we had 500 purchased on account, but we paid 300. So accounts payable was paid 300. Make that clear, okay? And that's why that shows up. So from your operating activities, you have revenues in cash and cash expenses. So your net cash from operations is $4,000. Net cash from operation is $4,000. And again, you'd probably list these in order of magnitude. Okay, if you ask, how do you list the cash payments? So cash flow from operations is $4,000. Now, net income was $5,300 on the accrual basis, if you remember, but cash generated from that net income is $4,000. Then, of course, from your investments, investing activities in the company, $2,000 in land. The financing activities are $30,000 to issue stock, less the dividends paid, or $25,000. The sum, $4,000 from operations, positive cash flow. Negative cash flow used to buy land, plus net cash from financing, $30,000 raised in stockholders' equity by issuing common stock, and dividends paid of $5,000. The net change in cash we know is $9,000. We know that the cash went from 0 to $9,000. Beginning cash is 0, ending cash is 9. And this, again, ties back, as I said, to the balance sheet. Okay, so it ties back to the balance sheet. The beginning balance of cash and the ending balance of cash. Again, a couple of points. Items listed on the statement of cash flows will be in the order of magnitude, typically. The ending cash balance on the cash flows, and for that matter, the beginning, but the ending is most important, is also found on the balance sheet. And again, this is the concept, the key concept of tying these statements together, which is known as articulation, financial statement articulation. So again, more formally, the ability to tie statements together is known as articulation. The articulation means there is interaction between assets, liabilities, and the equity elements, and revenues and expenses. And the 4 basic financial statements, as we will summarize now, are intrinsically interrelated so that the elements of the balance sheet are dependent on elements of the income statement. Elements of the income statement are dependent on the balance sheet, etc. Cash flow statement, statement of retained earnings, etc. And again, the key point that we made throughout this module is that all of the financial statements for the time being were prepared from the accounting equation or the balance sheet equation.